First off, I would like to discuss the reason why we are here in this Friday afternoon. Obviously, everyone wants to have financial success. It's either you want to have a windfall or you want your money to grow slowly with you. And it depends on your time frame and your whether you're invested in the long term or short term. Both will need some knowledge on technical analysis. And here we go. Okay, first off, if you can see on your screen, there is a chart on the PSEI index. This chart was created last July 29, 2019. And I have set targets for the chart for the PSEI index that might be possible towards the end of 2019. In the resistances, I'm looking at 8,200. And then next one is 8,360. And then 8,500. And then eventually the 9,000 level, which is the all-time high. On the downside, I see the support at 8,000. If this is breach, most likely we will see lower levels for the index in the coming months. As you can see on the screen, these are the key levels. Now, for us to maintain an upward bias towards the next 5 or 6 months or so, we need to understand the PSE index key factors. Now, number one, we always rely on a strong domestic consumer economy. Ours is a self-sustaining economy wherein most of the companies that produce products are sold locally. We also need to see strong corporate earnings. And we are hoping that the infrastructure projects, the build program of the government will push through towards the second half of the term of the President Duterte. Now, on the fourth one, the Philippine midterm election, it's over and done with. I think it was fairly peaceful. And the population has spoken, and they are supportive of the current administration. Now, regarding the US-China trade war, which is really affecting not only the Philippine stock market, but the whole capital markets as well in the world, we have to understand that US buys most of China's products. So they are negotiating on a stronger perspective. But we also have to understand that China is now looking for other markets, especially the Asian market. And we also have to take into consideration that China is the only buyer of US Treasury bonds. Now, what is a US Treasury bonds? These are government IOUs. These are essential for the United States to continue its day-to-day operations. Without these Treasury bonds, they will probably be closing shop. My verdict for the 2019, I still believe that the market will be so good. Paid gurus, mentors, and subscription will run out of business. I'm expecting that towards the end of 2019 or early 2020, we will see the market hit all-time highs. Now, together with this, we expect select issues to give multi-bagger returns. And for us to have a clear understanding, we really need to have a good background on technical analysis. My topic for today is technical analysis and beyond, and I hope you find this a very useful tool in your trading decisions. First topic is Fibonacci retracement. Fibonacci retracements are ratios used to identify potential reversal levels. These ratios are found in the Fibonacci sequence. The most popular Fibonacci retracements are 61.8%, 38.2%. Note that 38.2 is often rounded to 38 and 61 is often rounded to 62. After an advanced knowledge, chartists apply Fibonacci ratios to define retracement levels and forecast the extent of a correction or pullback. What is a retracement? Retracement are short-term price corrections during an overall larger upward or downward trend. These can be used for short-term trades. How do we do this? You have to remember that there are swing high and swing low levels. After a series of up markets for several consecutive days, you will see a reversal. On the swing high, you will see the first red candle after a series of green candles. On the swing low, you will see the first green candle after the series of red candles. On a broader extent, this is how it looks like. We have a Fibonacci retracement that is going upward. As you can see, the green candles reached the 0% level, and then the following day, it corrected and formed a red candle. It reached all the way to 23.6% of the retracement. Now, more often than not, it should go to around 50%. On the downward level, we can see that the red candles also reach the 0 percentage point, and then the green candle appeared the following day. It reached the resistance at 50% and then continued on with the down red candle. Now, how do you take advantage of this? Most move will retrace around the Fibonacci levels, specifically around 50%. So if you see a chart going strong, going up for several days, and then a swing high was detected and a reversal is confirmed, what you normally do is wait for it to reach the 50% to get into the stock again. That way, you will not be a victim of what we call FOMO, fear on missing out, where you keep on trying to catch up with the fast rising stock. In the same manner, when it's going down, if you want to sell again, you wait for it to make a retracement to 50% so that you will be able to get a good price. My verdict on Fibonacci retracement, it's good for intraday trading or short-term trading. You can also ride the swings or corrective phases of the market. But more often than not, this is not used on long term. Our next topic is I made this I think most of you are familiar with my KISS principle, and I have done several seminars all throughout the country with this, and I have come up with this conclusion that a lot of experts like to complicate things so they can charge higher fees for their services. Now, let me tell you this, they themselves don't know what they're talking about. We'll find out in a few minutes. Next topic is Elliott wave theory. Elliott wave theory is used to analyze financial market cycles and forecast market trends by identifying streams in investor psychology, highs and lows in prices, and other collective factors. Elliott wave theory is somewhat based on the Dow theory in that stock prices move in waves because of the fractal nature of markets. However, Elliott was able to break down and analyze them in much greater detail. Let's go further. Dow theory is an analysis that explores the relationship between the Dow Jones Industrial Average and the Dow Jones Transportation Average. When one of these average climbs to an intermediate high, then the other is expected to follow suit within a reasonable amount of time. This is somehow happening when regards to Dow Jones and then the Philippine Stock Exchange. Some people believe that when the Dow Jones goes up, the Philippine Stock Exchange goes up. On the other side of the coin, if Dow Jones Industrial Average goes down, the Philippine Stock Exchange Index also goes down. But believe me, in the past 24 years, I have seen PSEI move ahead than Dow Jones Industrial Average. Now, further to the primary of Elliott wave. fractal is defined as a curve or geometric figure, each part of which has the same statistical character as the whole. Fractals are useful in modeling structures such as eroded coastline or snowflakes, in which similar patterns recur at progressively smaller scales, and in describing partly random or chaotic phenomena such as crystal growth, fluid turbulence, and galaxy formation. Now, I leave it to you if you understand what I just said. I have been in the market for 24 years and I haven't understand the meaning of fractal. This is the traditional Elliott wave pattern. You see waves 1, 2, 3, 4, and 5, and then the concurring pattern of ABC. Now, for Elliott wave to work effectively, this pattern has to be formed. My problem in this Elliott wave pattern is that most of the time, on the third wave, the fourth, which is supposedly another step towards to higher prices, doesn't happen. And when it doesn't happen, you have to reset the Elliott wave pattern. So it's very selective. Very few stocks follow the pattern. Aside from the traditional pattern, it also has categories. We have what we call the grand super cycle, the super cycle, the cycle, primary, intermediate, minor, minuet, and sub-minuet. If you follow gurus or stock market experts using Elliott wave theory, it is very difficult to ask them which cycle we are in the moment. Because if the pattern doesn't follow through, usually you will be given excuses that we are currently right now on the super cycle minute of the sub-minuet, which is really very complicated for even a tenured trader like me. Now, my verdict on Elliott wave theory. Elliott wave theory is good if the pattern is completed, but if not, it's a very complicated theory for me. And I think you will agree. And maybe put this Elliott wave theory probably down the burner, or if you have experience enough and read about technical analysis, maybe you can consider using this one. Next is Japanese candlesticks. The candlestick charts are thought to have been developed in the 18th century by Monisha Homa, a Japanese rice trader of financial instrument. They were introduced to the Western world by Steve Neeson in his book, Japanese Candlesticks, Charting and Techniques. What you're seeing on the screen right now is the bullish and bearish sticks. These are the fundamental candle formation. On the bullish side, it will be bullish or green in color if the closing price is higher than the opening price. On the opposite side of the coin, the bearish candlestick will become red if the close price is lower than the open price. Okay, so let's proceed. These are several bullish patterns that you have to understand if you want to use Japanese candlesticks. Bullish breakaway, bullish concealing baby swallow, bullish doji star, bullish engulfing. Now, the problem with this one, it has to have also a series of candles so that you can have a better understanding on the patterns. Just like Elliott wave theory, I find this very complicated. But there are several traders I know that uses these Japanese candlesticks and are very profitable on their trades. Bearish patterns, the same thing. Abandon baby, advance block, breakaway, dark cloud cover, so on and so forth. My problem with this one is that sometimes you will see a bearish pattern, supposedly bearish pattern, for example, three line sticks. But if you will look at the previous chart, patterns, It's almost the same as bullish engulfing. So, which is which? Dodgies. Um, this is very effective in predicting the following movement of the stock. For example, if it forms a hammer, um, the following day should be a bullish uh, price action for the stock. If it forms um, gravestone doji, it's going to be a bearish price action for the stock. Now, my verdict on Japanese candlesticks. The Japanese people have been trying to figure out to use it for centuries, and then feel free to try it on your own. Now, we have to understand that in every sector of the society, there are people who are center of influence. In the investing or stock market world, we have two people, very famous people, Warren Buffett and George Soros. Both have a very different approach, but have the same and what I consider the most effective strategy in the stock market, which is buying high. No, it's not buying high, it's buying low and selling high. Warren Buffett chooses or picks companies that are in trouble but have a good history of making money. So he buys them on a discount, and then he takes over and then reverses the fortune of that company. So it's still the same. He buys low and then he sell high. George Soros is the grandfather of shorting. What is shorting? Shorting is like selling a commodity or any underlying stock, hoping that you will be able to buy it at a lower price. So he looks for companies or, for example, currencies that are in trouble. He sells them and he buys it back later at a lower price. So it's still the same. He buys it low and sells it higher. According to George Soros, unfortunately, the more complex the system, the greater the room for error. That is actually true. True on Elliott wave, and should consider also true on Japanese candlesticks. That's why I'm an advocate of keep it smart and simple. What is keep it smart and simple, or the KISS principle? The sheer simplicity will make you realize that you don't need a complex strategy that will only produce mouse-sized profits, but rather you can have a very simple strategy that will give you a lion's share. How does it work? You have to identify a clear edge, something that in the long run puts the odds in your favor. First topic is support and resistance. Now, support is the price where sellers refuse to sell, and resistance is the price where buyers refuse to pay. Very simple. If sellers refuse to sell, okay, what will happen to the price of the stock? It will start going up because buyers are now forced to buy at a higher price. In the same token, on the resistance side, if buyers refuse to pay, sellers will be forced to sell at a lower price. Then the stock prices will start going down. How does it work on a real chart? This is a 12-month price of mango. And for the last 12 months, the highest price it went to was 120. And the lowest price it went to was 25 pesos. Now, common sense will tell you that you should be buying around the 25 peso level and then selling it at around 120. Now, but you have to understand in the market conditions, there's no genius out there that can guess the high price of the stock, and there's no one also that can predict the lowest price of the stock. So if you have a 12-month price range, what you do is to take the average, or at least get some target prices wherein you can buy or sell. Now, if the highest price is 120 and the lowest price is 25 for the last 12 months, most likely I will start buying at 40, all the way down to 25. And when it starts going up, I would be selling my position at around 80 all the way to 120. Now, what is the common sense behind that strategy? If you bought it at 40 and you start selling at 80, that's 100% return. So who wouldn't want to have 100% return? You also have to consider volume. Volume is the number of shares of a security that are traded during a specified period of time. It tells you how many shares change hands between buyers and sellers. It offers a complete picture of the market and is an indicator for supply and demand. Let's take a look at it at the charts. As you can see, every time it poses a significant increase in volume, like the ones encircled below, the green volume spike represents buying. Prices usually goes up. The red volume spikes usually indicate selling, and then slide in prices takes place in the following days. You can compare this in your charting softwares and then add volume as an indicator. Another indicator that I use is stochastic. Stochastic is an oscillator that measures overbought and oversold conditions in the currency market or any other capital markets. Blue line crosses above the red line is a buy signal, and then blue line crosses below the red line is a sell signal. Very simple. I think we can distinguish a blue line crossing above and then a blue line crossing below. Let's look at it at the charts. This is a chart of Mega World. As you can see, pointed out by the red arrows, every time the blue crosses above the red line, it goes up. Every time the blue crosses below, it goes down, so on and so forth. There's no magic involved in it, just a very simple indicator that you can use. Now, the 80 and 20% representation is the overbought and the oversold levels. Most of the time, blue line crossing above is somewhere around 20 or 30%. And then at the same time, the blue line crossing below occurs somewhere around 80 to 100%. You also have to put into consideration breakout. What is a breakout in prices? Breakout is a stock price that moves outside of a defined resistance level. This is an example of Bloomberry. Now, for the period of May 2017, we have a resistance set at around 810 and then a support at around 710. So you can trade it effectively, buying it at around 7 and then selling it at around 8 pesos. But if you can see it around April of 2017, it had a breakout. The prices went beyond 810. Now, what triggered that move? If you can see below the indicator, the volume showed an increase for several days, and it continued so on and so forth to the point that it actually created 810 as the new support rather than a resistance. It broke through that resistance of 810 and went on to trade above, I think, around 9 pesos. So 810, the normal resistance, became the new support for the stock. So what you should watch out for is in breakout is the volume that accompanies it. Opposite of breakout is, of course, breakdown, a stock price that moves outside of a defined support level. How does it look in a chart? This is the breakdown chart. Support is established at around 880 with resistance at around 1050. You can see that sometime in May, around second week to last week of May, the price went down and broke the support level of 880. Now, what accompanied it is a selling volume, and the selling volume continued until July of, I think this is also 2017. I forgot the particular name of the stock, but it doesn't matter. A breakdown, same with breakout, is also accompanied by a volume, but this time selling volume as indicated by the red volume spikes. Now, aside from the indicators that I have mentioned above, I also use common sense. What is common sense? The ability to think and behave in a reasonable manner and to come up with good decisions. I think everybody is capable of using common sense. If you cannot use common sense, then you are fairly uncommon. This is a stock called Megawide. As you can see, I have established the support and resistances. Now, support and resistances can also mean an upward trend channel, just like the one you're seeing on your screen right now. I have established the support at 640 and set targets at 760 and 860 for 16.9% and 32.5% return. This is for the stock called Megawide. I made this call on June 10 of 2016. Now, why did I make a buy call on this one? As you can see, stochastics just gave a buy signal, blue line crossing above, and then there's a significant increase in volume, mostly buying. Okay, so what happened to this stock after I recommended the buy on Megawide on June 10, 2016? Here it is. The stock went up significantly, even broke through my target prices. What is important though is that I set 32% as a target at 860 on June 2016. If you can see, by July 2016, a month after I recommended it, the 860 target price was already hit, and it went even further. Now, it doesn't matter if you miss the high prices at 8, 9, or 10, as long as you trade within your trading plan. My trading plan was to buy at 640 and sell at 860. 32% in 1 month is not bad. What is the common sense on this particular pick? As you can see on the date, this is June 10, 2016. Elections for the presidential position was just concluded, and President Rodrigo Duterte won that election convincingly. And on his first day of office, he immediately announced that he will proceed with the Build program. Megawide, being a construction company before, changed their strategy. From construction, they went into PPP, public-private partnership, and it worked wonders for them, gave them good returns. They were the first one to put up the Cebu Mactan International Airport, the new Mactan Airport. They also have some transport hubs ongoing, and most likely they will continue on their projects improving airports throughout the country. In 2019, I still have Megawide as one of my picks for the year. Bloomberry Corporation. I did this on June 3, 2016. As you can see, I made a recommendation on the following basis. It is trading on support at around 420. Stochastics, blue line crossed above the red line, and there is also a significant increase in volume. As you can see, the two green volume spikes shown on the chart. My targets for this one is around 540 for a 21% return, and then 660 for a 48.4% return. Let's see how it fared a month after. Actually, not just a month after. It went up to the roof, but my recommendation on June 3, 2016 was achieved as early as July of 2016, on the same year. So again, 48% in 1 month is not bad using the case principle. Another stock similar to Bloomberry, Melco Crown, made the recommendation. Now, the common sense about this is, again, this is sometime June or May of 2016. The presidential election was concluded, and what was important on that presidential election, when Rodrigo Duterte won, he immediately made a pivot towards China. Now, you have to understand that gambling is second nature for the Chinese. In fact, during Chinese New Year, most of the time they go on a holiday. The men or the husband plays in the big table. The women goes on shopping, and then the kids play in the pool or beaches. So when President Duterte made the China pivot, it is like it's common sense. Melco Crown, Bloomberry will make a killing on the revenues. Now, another company that is one of my favorite, International Container Terminal Services, ICT. Again, on June 3, 2016, I made a recommendation to buy at 57.50 based on the following parameters. Stochastics, again, blue line cross above the red line. There is significant increase in volume. And I have set my targets at 69.50 for 17.2% and around 78.60 for a 34% return. Now, ICTSI is one of my favorite because this is a company, Filipino owned, but it earns in dollars. So they invest in peso, but they gain their return in dollars. So they also make profits on the currency exchange depending on the situation at that moment. But at this particular time, June 3, 2016, the indicators were all aligned, and I said, let's go for it. Buy ICT at around 57.50. Let's see how it fared. Again, the targets were achieved in what? 2 months after it was recommended. What is the projected return? 34% in 2 months. Again, not bad. Using KISS principle. Another stock that I recommended on September 30, 2016, Agri-Nurture. This is one of the most controversial stocks because the owner, chairman, was somehow dragged into a political scandal with the B-Nice back then. The stock went from 150, actually 120, all the way to almost 6 pesos. I think the high back then was around 5.97. But after it was dragged into the Senate controversy, the Senate hearing, the chairman appeared on a daily basis. The stock went from 5.97 all the way to around 3 pesos. However, at 360, I made a call because of, again, stochastics, blue line crossing above the red line, bullish signal. Volume, again, was significantly higher. And the common sense I use on this one is that once President Duterte made the China pivot, this is, remember, an agriculture company. They produce vegetables and fruits. China has 2 billion population. It is common sense that they will be importing from the Philippines, and Agri-Nurture is one of those companies that can take advantage. And from 320, it went to as high as 960. This was, I think, January 10 of 2014. I also made the recommendation, and I said that it will close the gaps. You can see the encircled portion of the chart at around 11.40 and then at 18 pesos. It actually made it to 18 pesos. You have to understand also that this also has a gap at around 22 pesos. It is currently trading or hovering at around 14 pesos. With good fundamentals inside, who knows, it might just make a trip to 22 pesos again. Now, we also have 3 principles that have guided me to be successful in this business. And I hope you can come up with your own soon. My number 1 principle is you have to be smart but be simple. You have to be first but be calculated. And third and most important one, find a good mentor but be better. Because if you will find a good mentor and you will just be a mentee all your life, there's no way for you to succeed. Again, keep it smart and simple. Apply very simple methods in trading. Don't overcomplicate your trading. It's the same. Both will give you complicated theories, will give you good returns, but smart and simple will give you the same. Thank you so much, and I hope you learned something out of this session.